Thanks for joining here, Shubha. And again, we've had a lot of exciting talks today, and yours is going to tie it all together like we discussed. And Shubha is the founder of Achieve. Shubha focuses on advancing access to capital for women founders, especially in climate sustainability and STEM. Shubha also has Invisible Ink podcast. It's once a week. She does interview a lot of predominantly people in the sustainable women finance startup space. So if you want to check it out, do on her website. And yeah, you can just sign up and you would get a notification of all the podcasts going forward. In terms of topic for the day, today, so Shubha is going to talk about the other green part of sustainability. So we've been talking about sustainability in terms of your finances, your customers, your brand, and how do you bring it all together in terms of stakeholder, investor, and customer loyalty, even with misinformation out there. Now, what can you do to take this one step forward into actually things that impact your bottom line? How can you generate revenue but still be sustainable? So how can you generate profits but are impact-oriented profits and still be a profitable business, right? So sustainable businesses today face an added challenge of finding the right fit sources of capital. So if you're a sustainable business, number one, there is a challenge in terms of finding the right investor. It is not that investors are not there, but finding the right investor. And now after you find the right investor or investors, how can you showcase your business in terms of profitability and sustainability to be able to accumulate points in terms of positioning your business better in front of them? So Shubha is also going to talk about how do you build sustainable business models. So we know traditional business models, but how can you infuse sustainability into that? And we've been talking a lot since morning about long-term solutions. Anything and everything we are talking here today are not short-term fixes. And then that also does not mean you don't get to start until after doing a lot of research and setting up. There are small things you can do today and start building upon your business and solution that can add up to long-term startup viability. And Shubha is going to touch upon that as well. We'll also hear about a strong framework for founders to think through critical financial foundation. So if you are a sustainable startup, what are some additional considerations in terms of your finances, as well as non-financial factors in terms of qualitative and quantitative data, and how can you package them together to present in front of a customer or investor, right? And I'm going to hand over to Shubha. Over to you, Shubha. If there's anything to add, please do. Excited.
Thank you. That was a fantastic. Thank you. And thanks for this opportunity. Really exciting. I don't see all of the names and faces yet, but very happy to be here. And Bhuva, thank you. And Wallet Max, thanks for this opportunity. I think Bhuva did an excellent job in terms of introducing me. The only thing I'll add is I come to this event with over 20 years in finance. It's been mostly in banking and in management consulting with McKinsey. So I've kind of done the whole round, and it kind of all came together in terms of helping founders really who focus on impact, and specifically women and diverse founders. So that's kind of like my slant. And Invisible Ink, thank you for that as well. I interview women entrepreneurs who are predominantly STEM, sustainability, but I also interview women experts in finance. So anybody who can get you to build a solid startup that will kind of keep the distance and be enduring in terms of both its viability and its impact. So with that said, I'm going to hit on 3 different things, and I'm happy to either take questions if you raise your hand, or do it at the end, depending on Bhuva, how you want to do this. So with that, let me just jump right in here. So hang on, let me just, okay. So let's just set up a simple metaphor, right? Your eco startup or your sustainable startup is like a green vehicle, right? So first, there are 3 things you really need for this to work on a long-term basis. The first is you need a vehicle that's going to run. It has to be roadworthy. It can be the most eco-friendly or whatnot, but if it doesn't actually run on the road, then you don't really have anything to talk about, right? So the number one thing is a roadworthy vehicle. Second, you need a clean and renewable source of energy, right? There's dirty fuels and there's clean fuels, and there's quote unquote dirty capital that will destroy the engine of your vehicle. And there's also clean and renewable fuels in terms of the right fit sources of capital that Bua talked about. And then lastly, you also need controls. You need to know where you're going, how fast you're going. Are you out of fuel? Are you not out of fuel? So that's the metaphor that we'll use. And what everybody usually kind of falls asleep when you talk about finance. I come at it from a different perspective. I think finance is the most strategic and powerful tool that a founder has. You don't need to rely on anyone. It's not rocket science, and it's something that we all need and must have, especially I'll make my personal plug, especially if you happen to identify as a woman or any non-male gender and happen to be diverse in any way, then this is my personal appeal to you to take this as a challenge and definitely make it a really powerful ally in your favor. So with that said, what that means is, as I mentioned, the roadworthy vehicle is what it is a real tight business model. And we'll talk about how to make that workable for you. The clean source of energy is capital that is efficient and renewable. And as I mentioned, measures that keep you safe and moving forward as well. So let's just talk through all three of these in turn. So first thing is building a roadworthy vehicle. So I'm not going to spend a lot of time talking about all the tools that you have out there. There's business model, canvas, there's this, there's that. This is like having been through the route multiple times personally as a founder myself, as well as working with multiple other founders. I found that the biggest challenge is how do you bring this all together? We don't have unlimited resources. We don't have unlimited time. So we need to make this all come together. And typically, I don't know about you guys, but I have never had a check, somebody write me a check for $350 million, like, Adam Newman of WeWork. So we've got to make do with limited resources and still build something sustainable and worthwhile. So the how is where the challenge lies for most of the founders that I've seen, as well as it's a challenge that I've kind of had to contend with in the past. So here's a simple 3-step process. Think about building your roadworthy vehicle as making it work, right? Do the parts all fit together? Making it pay, meaning can you turn on the engine and make it actually run is kind of like making it pay. And making it scale does it have the strength and the endurance to actually run for a long time, right? In terms just of how it's built and how it's engineered together, right? So in terms of making it work, think about it at the smallest level, right? What is your customer identity? What is the trigger that will allow them to say, hey, look up and say, here's something that I either want to consider or will consider if it showed up, in my radar screen. This is not easy. And, I can actually take questions and kind of maybe we can talk about it if you have time at the end, but you need to be really surgical and really precise. And this is the place where for many of the startups that I work with, the question is, that's hazy. And unless you get that with surgical precision, it's very hard to move forward. And then how do they decide to try something that you offer? So let's say you offer, I don't know, an environmental friendly laundry detergent. Let's take that as an example. What is the specific moment where whoever is responsible for doing the laundry says, gee, I think it's time for me to move from Tide or whatever it is to come to this and give it a try. And then once I decide to give it a try, how do I either sign up or kind of get my hands on it? And then what exactly is being delivered, right? So in the case of a laundry detergent, it's easy, but in the case of maybe something that measures your carbon emissions, it's something very different. So unless you're able to really nail this down and put all of these things in one sentence, I would actually argue that you still have work to do and you don't have a machine where all the parts fit together. Second part is how do you make it pay? How do you make the engine start, right? So this is where everything comes together. What is the exact product and how are you going to package it? And this is one thing that I really emphasize and I've seen over and over with many founders is the category is the most important thing, right? People on the other side of the checkbook who are writing you the check and saying, I want to buy XYZ. They're putting whatever you offer in a box, whether it's B2B, B2C, like there has to be a box in which it fits. And that is the category that defines pretty much everything that's going to happen after this. It defines what kind of market you're going to play in. It defines what investors are going to find you attractive because investors play by category. And it defines, what financial institutions will do for you. So people kind of assume this. I would challenge you not to assume it and actually make it a very thoughtful, intentional decision. Then the question of what is the price? How are you going to make it? What is the cost? And for what profit? Now, all of these sound normal, but I'll tell you from experience and from seeing other founders kind of struggle with this is working through it literally on a piece of paper and pencil And understanding what it means at a single unit level is the single most important thing you can do to ensure viability of your business, right? So that's kind of like part two. And part three is you want to make sure that if you have a car that not only all the parts work together, the ignition is connected to the engine and so on, that it actually turns on when you turn it, but then it also runs the distance. You want to go on a 500-mile trip from Chicago to, I don't know, DC. You want it to be able to do that, right? So for that, you need a scaling mechanism. You need staying power. And in the case of your startup, what that is what is your sales and marketing engine? How is that going to work? What is your production platform? Now, in the case of a widget, if it's laundry detergent, it's easier. But in the case of something more intangible, you might have to think through it and say, okay, what are the skills and resources I need? How do I bring them together? Are they going to work? And then what is it all going to cost me, right? At the end of the day, if you're taking more resource in from the environment and putting out less, that doesn't apply just to the specific thing, like whether it's carbon or metal or whatever it is, but it also applies to economic resources. So what you're taking in is costing more than what you're putting out. It's not really sustainable. So we can talk through what that means, but at a very basic level, make sure that a single unit that you're putting together, whatever that is, it's a service, a report, a bottle of laundry detergent, that you're able to make more by selling it, a single unit of it at the unit level, and also at whatever scale that you think you're thinking about, I don't know, 100 units a year, 1,000 units a year, whatever that is, you may not be able to make it immediately pay, but certainly as a founder, if I were an investor, I would expect you to know what you need to get there and what you expect it to cost. And then, of course, you need a bunch of people, resources to make it all happen. And at some level, you need, and we'll talk about this more in detail, but what funding do you need, right? Are we talking about, I need like $500,000 to keep going for the next 2 years. I need $1 million. I need $10 million, and I need $100 million. You don't have to know the exact details just yet, but you should have a rough outline of, am I talking small animal or big animal? Okay, makes sense. Any questions so far? Feel free to raise your hand, please. Okay, and Bua, please keep me honest if you're seeing questions, because I'm not sure I'm seeing them the way I'm presenting.
Yeah, I'll read them out, Shubha.
Okay,
Thank
there
you.
is a hand. Somebody raised a hand. Go ahead. I don't know how to say your name. Is it Primi? Primi? Go ahead, please.
I think Premi may be talking, but we can't hear. So Premi, if you want to drop your question in the chat, that will be great as well. So we can read it out for you.
Sound check. Can you hear me
Okay.
now? Sorry.
Yes.
It wasn't connected. I have a love-hate relationship with Zoom. Apologize for that. I'm still at an early stage of my business. We're in the process of validating our product idea, and I'm actually at the fork road, as you've hit a lot of points for me, and I do appreciate this. Based on your experience and wisdom, I really love all these points. So I really want to hit like the grassroots level. I'm actually launching this product in the Philippines, but I'm developing it here, standpoint from Canada, because it's easier to reach investors wise. So in terms of impact, I really want to help businesses, especially the growing markets, on sustainable businesses, specifically the franchise supply chain, because it's quite a big market, but we're looking at the sustainability markets. It's where my co-founders are really very passionate about. So we want to build a platform that it can help them track in terms of their ESGs. But we want to start small, something that's easy for us to track with at the beginning, and we want to validate that idea. So targeting grassroots, and you were mentioning about the pricing and the cost, it might sound like it's very philanthropic kind of pursuit, because we want to give it free at the beginning and get as much as we can. But then ultimately, you were talking about the scaling and how we're going to get money, because you want to be sustainable and profitable. So I think right now I'm still like figuring out the pricing, and you were saying think about like an overall idea of how much it will cost for you in the long run. Because right now at the by June or July, I'm really hoping to raise funds. So I'm actually lucky to be part of Founders Institute Toronto. but there's we have some mentors there. But I'm still the reason why I joined here because I saw the posting
Oops, you froze up there. Can't hear you.
Founders
I don't.
Institute flag and like, oh, this. Hello.
Yeah, go ahead. Now I can.
Okay. Yeah. Yeah. So I guess the mission is to help grassroots. And when it comes to pay, like having them to pay the product in the long term, but offering it free at the beginning, but I still want to keep like a free service. But I'm really like still figuring out like having a metric as to like when you say grassroots, they can't really afford so much money, and
Yeah,
like
that's fine.
probably
Yeah.
like $10 maybe too much for them in a day because the living wage there is like $200. So taking away $10 is already too much. Um, so that's where I really want to make a dent, but of course, hitting the right funders, placing, positioning, and there was mention about like the branding of your culture or what you're really going for. We're social impact driven, and we want to make that. We're targeting 70% employment rate from PWDs and marginalized community, and that's what we have on our staff. So I'm not sure really what I'm asking here, but when it comes to I
So
guess with the funding, because I'm pursuing for funding by June, July.
okay, so
Yes.
we'll get, so I think there are a bunch of questions there. Let me just try to address the one that maybe applies to this, and then we'll take, if I don't address the other funding related questions, then you can come back and ask me again
Okay.
if that works.
Yes.
So in terms,
Sounds
what I
good.
heard loud and clear is the price is zero. That's fine. Nobody said price has to be positive. The
Okay.
one way to say it is a price is zero from these people, but you have to get the money from somewhere else, right? So then it brings the question of who are you selling to? So you're selling first to the people who are going to use. So they become your users, but you still have to have a buyer on some basis. Who's buying?
Mm-hmm.
Somebody's buying your philanthropic mission, right? That's a funder. So you still have to understand what is it costing you to sell whatever this is that you're making on a per unit level? What is it
Mm-hmm.
costing you to bring it to the market? And then what do you need to have to sustain it to go ask XYZ person because they're making investment, even if it's philanthropic.
Mm-hmm.
These days
Mm-hmm.
I'm on 2 nonprofit boards, and obviously we survive on a lot of fundraising. So the
Okay.
question is, you're asking me to make an investment. I don't expect a return in terms of you giving me a check, but I'm expecting a return because you're taking my dollars and using it for something. So help me
Okay.
understand what the investment return is. So for those, regardless of what you do, you need to understand what is the economic profile of whatever you're proposing. If not for anything else, you need to understand if you're doing it the best way possible, or if there's a better way to do it. And to think through precisely these, like, who are my constituents? Constituency X pays zero. That's what you're telling me. Fine, that's your call. You're the entrepreneur, you get to make those calls. But somebody still has to pay for all the things that go into this. Who is that person? On what basis are they paying? And what are they getting in return? Which could be satisfaction. It could be a foundation that says, hey, our mission is to serve XYZ community. So you need to be able to give them something in return that says, here are the metrics that help you feel happy or satisfied that you have satisfied your mission. So your point is well taken. Regardless, I would challenge you to say, think through what that means at each of these. They don't have to have the narrow definition that you've seen in economics or business textbooks. So let me keep going. I want to be sensitive to the time, and then we'll come
Thank
back.
you.
It's a great question. Thank you for asking.
Thank you.
So then, let's say you work through this, and to your point precisely, Priya, I think and I don't know if I butchered your name. I apologize if I did, but you brought up an excellent point, which is this is not an easy process, and this is where a lot of founders tend to get discouraged. And I understand that. I've been there myself. But you need to go through an iterative process of experimentation to say, I'm going to test this, I'm going to test this, I'm going to test this at a very small level and understand what's happening. Like, what am I understanding about these boxes? Do I know what the price is? Do I know who the payer is? Do I know who XYZ is? And I have a little something for all the attendees at the end, which I'll share in a few minutes. But the simple way that I like to do this, you certainly have tools. There's no shortage of tools, right? You have business model canvas, you have lean canvas, you can use any of those. I find them less useful because they don't tell me how everything comes together in a step-by-step waterfall that says, I'm doing this, Therefore, I'm offering this, and this is how I'm going to bring it to market, which is a story you need to have rock tight if you're going to go to get funding or any kind of stakeholders, to be frank, right? Where they could be funders, they could be large partners that you need to sign up, they could be partnerships, it could be anybody, right? But you need to have your story straight. And I use this canvas that says, what is your startup in a nutshell? And your first level of testing is to say, my idea is X. Can you say in a single sentence, for this problem, my solution does this in this way, and here's why we're different. That's it, right? If you're not able to answer it in that space, like a Post-it note, then I would suggest that you probably need to go back, and it'll benefit you to sharpen that even more, because you need to be really focused. So then you said you're going to do this and you're going to deliver this mission, right? Okay, how are you going to do that? Well, our offering is XYZ. You could have the same exact mission and have two completely different products, right? So my offering is, in my case, I offer, let's say, laundry detergent for free. In some other case, it could be whatever else, but they're all satisfying the same mission. So you have to be clear, what is your category? Who's paying? Precisely to your point, Primi, that somebody has to pay for this on some kind of sustainable level. So you need to be really clear how you're going to pay, how are you going to get this thing in the hands of the people that you want to serve, and what is that financial safety cushion you have. That cushion can come from charging the users, or it could be coming from charging a buyer who's different from the user, like health insurance, right? My insurer pays, I get the insurance, I go into the doctor and get my benefit. That could be a funding model, or it could be a totally different funding model, like philanthropy, like you mentioned, or it could be a combination of all three. But you need to be really clear how those pieces fit together in terms of bringing this idea from a product to your market in a way that you're able to do it repeatedly. And then the last piece is, okay, what is the machinery that's going to make you able to do this, right? Are you thinking of doing a small scale business, or is it a large scale business? Again, these are not things that anybody imposes on you. You as the entrepreneur or the innovator have the leverage to say, I will choose this scale. If you're building Uber, you're somewhat constrained, but in many cases, in most cases, I would argue that that is actually much more in your control than you would imagine, right? You can start small, build much smaller. 99% of successful businesses go that way. They don't go and get the $350 million check from Andreessen Horowitz or whoever, right? So I would say, think through what that scale looks like, and what does it look like in 5 years? What does it look like in 10 years, 20 years? Or what does it look like in your most expected scenario, worst case scenario, or if all your dreams came true? These don't have to be quantified, but putting the thought to say, what does it look like, will force you to address questions like, well, can I think of another company that looks similar to this? And then you start pulling in different components, pieces that work together, and all of those help you get to that end goal faster without wasting a lot of time and energy. Then obviously team and skills, who is going to execute this? It could be you, it could be co-founders, it could be employees, it could be, I don't know, volunteers, right? I've definitely worked with volunteer force. It could be contractors, but it helps you think through, I need a marketing skill, I need XYZ skill, I need a production skill. You need to think through that and have a very quick and dirty post-it size note, idea of how that's going to happen, which all brings you to, you pick a certain business model, a certain way to make this happen at a certain scale with a certain team, right? Each of those paths comes up with a different capital number that says, hey, I need, for this, I need $100,000, or for this, I need $1 million. But without knowing all of these other things, it's very hard to go in and say, I'm going to fundraise. And this is something I've heard from, especially from angels. They're like, people just come to me with like these asks for $2 million and $5 million, and they're not able to articulate any of these things about why I'm going to have to give them $5 million or $1 million, and what they're going to give in return. Like, what are they going to plan to even do with it? So make sure that you've thought through all of these steps carefully before you even think about going to a fundraising, effort, because that's a whole full-time job in itself. Buva, I'm going to keep going just so I can cover everything and then come back to questions if that's okay with you.
Yeah, sure.
So with that said, how do you bring it all together, right? My simple answer is keep a spreadsheet that says, here's the thing that they want to know, whether it's you or they, whoever. You're the first investor in your business, so you should be asking yourself these questions because you're putting your precious time. You all have X amount of time. So make sure that you're putting it in the right spaces and the right places and for the right reasons. For each of these questions, make sure that you have your answer, which is your current working hypothesis. And the moment you go to an external party and you're asking them to give you resources, especially funding, they're going to ask for receipts. Bring me the receipts. You're saying that I'm going to serve this market, right? Or this customer. I'm going to say that this is my go-to-market strategy. What is the proof? Why should I believe you? And this is a part that I think many founders miss in their excitement for, oh, I'm going to, change the world, which is great. You need to change the world, but you need to bring receipts for that. So you have to have proof and making sure that you think through each of these. And the proof doesn't have to be, I have 10 months of sales. That's one form of proof, but it could also be, it depends on what you're answering, right? It could be a very reputable research report from, I don't know, someplace. It could be something somebody else did. It could be proof of a different business. It could be any of these things, but make sure that you have a rock solid basis for why your answer is what it is. And then the last two columns are where you can really get a leg up when you're fundraising. Think through what are the risks. The first thing that an investor wants to know is what is the risk, right? And they want to de-risk this as much as possible. So if you go a step ahead of them and say, okay, I'm saying that my distribution channel is, I'm going to go to the grassroots. I'm just speaking on you, Primi, sorry. So I'm just using you as an example since you're here. So let's say that you distribute it through the village cooperative or whatever the case might be. What can go wrong? So you need to be thinking one step ahead and saying, oh, you know what? I think it's going to work, but these are the risks. The more you talk about risks, the more the funders are going to be attracted and say, oh, this person is a safe person for me to hand over my money because they actually know how to steward this, and they're going to clip all the risks. And then therefore that brings you to, okay, we know it's a risk, but we think it's an intelligent risk to take because we've got all of these mitigation actions, which is your last column, right? So once you think about these risks, each one of these is a thing that can go horribly wrong. And I'm as an investor, I'm looking at it, I'm like, yeah, you say you're going to target this market, but here's the 5 things that can go wrong. You say you're going to, this is your pricing strategy, but these are 5 ways it can go wrong. So help me understand, have you thought about this? How are you going to address this? Because the one thing you know for sure is that everything's, not everything, but something is going to go wrong and not as expected, right? So do you have a plan, and are you thinking ahead to say, here's how I'm going to do it, here's how I'm going to address it? Once you have this kind of your control sheet, then your life becomes a lot easier. And then you know that you focus only on the 2 or 3 critical things that are going to make or break your startup. Don't get distracted by things that don't matter or that matter way down the line after you've figured out what your solution is and how you're going to monetize it. So that is kind of like the first part. Now, once you've done this, you know that you've got a car that presumably works, right? Or is well on its way to working, or is good enough to get started. So the next question is, what kind of fuel are you going to put in? Is it diesel? Is it going to be electric? What's the right source of fuel for you? You want it to be efficient, you want it to be cheap, you want it to last a long time and not destroy your car, right? So let's come to capital. And Buva referred to this. So whenever we talk about funding, or at least I've listened to funding, everybody immediately comes to, okay, let's go pitch. And pitching usually means, although it's not said as often, pitching means VC funding. Well, guess what? You know, VC is just what, like 223 billion, and less than 1% of all startups ever get VC funding. And of the ones that get VC funding, a very small percentage of them actually succeed, right? So one thing I'd encourage you to do is, when you think about capital, there are 2 things that you as the founder need to think about, okay? As the founder, you're going to ask, there are a bunch of other things to ask, but the number 1 things are, how easy is it for me to get? In other words, if I'm going to go pursue this, what are the chances I'm going to get it? Like, how many, in simple terms, how many VC meetings do I have to take to even get someone to be interested? And then once they're interested, how many of those interested VCs do I have to pursue to actually get a deal? And is that deal even good, right? So think about how easy is it for you to get that source of funding? And then how much control does that leave you? So VC, as an example, typically is very hard to get, and it also leaves you with very little equity. So to me, that's like that's the last resort that I would ever go to as a founder. I'll ask somebody to go to as a founder, right? Unless you have some overarching reason why this doesn't apply to you. What I would encourage you to think about is to go well beyond this and look at all the other sources. So some of them are more obvious. So for example, angel investment. So lots of people know that there's angel investing, there's crowdfunding that's kind of coming up. But as of late, you know, especially as I dig more into this, I've started to learn more and more about alternative capital, what's called generative capital. So these are capital providers or investors who don't want to just take everything out of your business and make you grow as fast as possible, be as profitable as possible, as quickly as possible, and then, you know, exit in a huge, you know, in a huge blaze of glory. There are other options. So there's snowball impact management, I think is what it's called. I think it's out of the UK. They have a very different funding model, right? Where they want to make sure that you're keeping the capital inside and you're paying all your stakeholders well, which is a key part of sustainability. So I put it in the middle, but this is just to show that there are other options. A couple of other things that many people are not aware of, you know, there's supplier-based initiatives. There's a lot of suppliers have supplier diversity programs. And on top of that, they also have sustainability programs. So you happen to be diverse and you also happen to be in the sustainability field. It takes work. I won't say no. So it's not as easy, but it's definitely easier than VC in my view. And then there's other creative means of funding. So for example, I was talking to a founder. She's got an amazing concept that does 10 times what the next best alternative does. It's really super clean for the environment. She has Costco as a supplier, and I asked her, and she's looking for funding. I said, did you go talk to Costco? They've already proved to you that they like you because they're writing checks for your product. Why would they not? Maybe they fund you, right? So don't be very creative in how you approach these things. And then the last thing, which I think we absolutely have to talk about, is it's hard, but government grants are huge. Remember that the government is the biggest venture capitalist in the world, especially in the West, right? The US is the US government is the biggest venture capitalist in this country. And just as a small example, the funding that has been set aside in the Inflation Reduction Act comes to $550 billion. The entire VC market for all sectors is only about $230 billion. So we're talking twice the size, and the government is extremely transparent. They are committed to diversity. They're committed to sustainability in many of these sectors that we're talking about. Of course, it's a different animal. I think my next episode on Invisible Ink is with, not this week, but the following Tuesday is going to be with somebody who knows this field very well. And she talks about how you should get a grant and should you even get a grant. All of this is to say, think broadly and think about many more factors than just I need VC capital, right? So with that said, how do you know which is the right source of capital for you? So now I've talked about your founder view. I'm going to ask you to go get up from your chair, figuratively speaking, sit on the other side of the table as the person who's funding you. Okay, so in your mind, get up from your chair, go across and walk to the other side of the table or wherever you are, pretend to be your investor. Now, the way the investor is thinking about your amazing startup that's going to change the world, and I'm not being sarcastic, I'm saying you do need the enthusiasm, you do need the passion, but you also need the perspective of the investor. So what is the investor thinking about? Whether it's sustainability or not sustainability, doesn't matter, right? An investor is an investor at the end of the day. So what are they thinking about? They're thinking about two axes here. First, they're thinking, how much money do you need, which is the x-axis, right? Do you need a little bit of money? Do you need a lot of money? And that's why the exercise we talked about 2 minutes back, which is you need to understand, are you asking for $500,000 or $5 million is really important, right? And they look at you differently depending on whether, and this is not just when you go now. Remember that the first time you may ask for $500,000, but they're looking at you and saying, until I exit or until I have some kind of liquidity event, how much am I going to have to put into this thing, right? Is it 500,000 today and then $10 million tomorrow? Or is it $500,000 today and then I'm done and then I'm going to get checks back, right? So think about the totality of how much money. You won't know that for a fact, but certainly you as the entrepreneur are making strategic choices to say, if I go down this path and build this huge factory like Elon Musk is doing with the battery factory, then it's asking for a different set of investment than somebody who's just building, not just, but somebody who's building a different concept, which maybe just involves licensing, right? And you just need money to develop some electric battery and you don't need to build or intend to build, right? So think about that. And those are choices that are very much in your hands. No VC is asking you to make the big bets. Those are things you can make to improve the chances that your venture is going to succeed. So capital needs is one. And the other is very important, like the return expectation. What can they expect from having put the money in your venture? Now, Bua mentioned this earlier, in traditional investing, it's just all financial, but it's never all financial, right? There's always some other consideration. The question is it 99% financial and 1% other, or is it 30% financial, 70% other? You need to be very conscious of that, but everybody is expecting a return, and that return is not guaranteed. It's guaranteed maybe if you're the US government and issuing bonds, but other than that, it's not guaranteed. What risk is there around that, the return that they're giving you? And, I told you a few minutes ago that your industry and your category is very important. This is where it's going to make or break you, and you'll never know. Because when you're going to whoever it is, and you're saying, I need XYZ money, they're looking at you not as this earth-shaking, groundbreaking venture, but they're looking at you as one player in a category. So immediately they're starting out with, oh, you're in the category of consumer packaged goods. Yes, your laundry detergent is amazing. But in your consumer's mind, I'm still, when I go to shop, I'm going to look at the laundry shelf. I'm not going to go to a separate shelf that says things that change the world, right? So the investor is saying, okay, if you're a CPG, then normal returns are about 5% a year on an annualized basis, right? You put in X amount of money, you get out X amount of money, but it translates to some kind of an equivalent of putting it in, let's say, a bank account, right? That earns some X% of interest. So they're looking at what is that X%. So if you're in certain industries like CPG, they're by nature lower return, right? So that will immediately impact in a big way who that investor is who's willing to invest in you and also on what terms and how much they're willing to invest. So typically what you'll see is if you're in these consumer packaged goods, I'll give you the typical examples where women tend to start more and VCs tend to invest less. As an example, is media, consumer packaged goods and recreation are overrepresented by women founders, right? So things like service businesses, consumer packaged goods, the latest health snack, whatever you call it, they're all CPG and they tend to be not favored by VC. So you already know that you're going in with a handicap, right? But then if you look at software, if you look at now energy, because there's so much money from the government, right? Software, energy, to some extent, healthcare, right? These are the places where VCs love being in because their expected return is very high. So going in, you should know which box are they going to put me in already. And I created like an archetype here. So think of when you go in, before you ever go in investing or getting money, ask what kind of archetype are you? Is your startup. So for example, if you want a lot of capital and you're going to promise you're going to take over the world because there can only be one Uber and all the lifts will shrivel up and die, then you're an aspiring unicorn. So you're a very prime candidate for VC, right? So your capital needs are high, your return expectations are high. Let's say that you are a software company and you're going to revitalize, I'm just making this up, revitalize the entire air traffic control industry because it's so inefficient, it's causing all these delays, but you're going to build this huge platform. The problem is that the capital need is still high, but your returns are not as high because the government is only going to pay you X amount of money. And also it's a very risky technology and it's going to take a long time. So then you'll be like a hippo, which is a highly important project possibility, but at the same time, the VCs are not as attractive. So these typically tend to attract more the government grants and stuff like that, right? So you need to be thinking on the other side and saying, what do I look like when I walk into any funder's office, right? Maybe an investor, maybe not. Then there are things that don't need as much capital, but are still very high growth. And a lot of software-enabled businesses, I call them gazelles. So think about, I know someone who's building like an AI-enabled content generation platform for a specific segment of the market, which is severely underserved right now. And she's going to B2B, she's gotten all the proof, but she's not ever going to be Uber, but she's going to grow pretty fast. So, and her returns are expected to be pretty high. So she's like a little tiny Uber, right? But she doesn't need that amount of money. Maybe VCs will like her, maybe they won't, but maybe there's a strategic investor, right? For example, if you're doing the laundry business as an example, and you expect to grow really fast, maybe the right investor is Procter & Gamble, not Andreessen Horowitz. That's a strategic investor. They're corporate venture funds, whole bunch of other strategic investors. So I call them the gazelle. So are you a gazelle or you're a unicorn? And then obviously there are zebras is my favorite. And this is where I've seen a lot of the women that I work with fall into, or the sustainability and impact people, which is that you have, you don't need as much capital, but you also don't have as much risk, and your returns are moderate, right? So you're a steady pace, healthy outlook, but you're never going to generate a $10 billion exit, right? So I call them the zebras, and these are very, very good bets for alternative capital, impact capital, and things like that. And then last but not least, we have little hares. They need very little capital. They may make a lot of money. They're little, not a lot, they're hares, right? And especially if you're already generating revenue, I would suggest you look at things like revenue-based financing, equity crowdfunding, and things like that. So going in, understand what you want and what you think you're going to offer, because you're offering something in return. You're selling yourself as an investment to whoever that is. And therefore, what do you think is reasonable for you to, and how can you optimize the resources that you go to? I'll try to keep it brief. And I'm happy to share this later, but the way you do it is I created a capital canvas where you kind of walk through a systematic process that says, these are my sectors and categories. We already talked about why it's so important. And then think through, what is your scale and size target? How quickly do you think you're going to start generating your first cash? Whether that's as a liquidity event, meaning that you sell to Procter & Gamble, or it could be that, hey, I don't ever want to sell. I want to run this for life, but I'll give people dividends. That's okay. You can pick strategically what your financing options are going to be. And what is your source of superior returns? Why are you different than anybody else? And how does it translate into a superior return, either financially or in terms of mission that your funder is looking for? So all of these lead to different sources. We talked about them, right? So you should at least start exploring, say, okay, this means that I should not go to VC, I should go to XYZ, right? I should go to a strategic funder. Then you talk about sequencing. So for example, let's say you're building that air traffic control platform that I talked about. You'll first go to government grant, not VC, right? Or you'll first go to this and then to someone else. So think through, and this won't be right, and this is a living document, you'll figure it out. But by going through that thought process, you'll clarify a lot of things in terms of what you should do and what you shouldn't waste time doing, which is like running after a whole bunch of investor meetings where it's not going to really pay off for you. right? So you're very strategic, very thoughtful. And also it might actually impact the other way, which is, I think I should run my startup a little differently and I should build it a little differently, which means that it's functioning as intended. It's excellent, right? You're building a better startup. Then the third is, how do you structure your financing? We don't have time and it's out of scope to go into structure, but know and be very cautious that the financing you get is structured in very different ways. And these mean very different things for you in terms of control, in terms of ownership, which are different, by the way. Just because you own 90% doesn't mean you have control. And just because you have 1% doesn't mean you don't have control. Everything is negotiated, and be very careful, get a fantastic lawyer. I'm not the right person, but understand there are different structures. There's convertible, there's debt, there's this. It is not boring stuff. This is the stuff that's going to make a material difference for you 10 years down the line or 5 years down the line when you build a successful startup. And then people are going to figure out, oh, this is how we divide up the spoils. And then you'd be like, oh, I did all the work. But they'd be like, yeah, but look at what you agreed to. You said you're going to give us all this if this happens. So it matters. Be careful, right? And lastly, all of this then will give you your capital stack, right? What's at the bottom? You talked about the sequencing. The stack tells you what structure, what source, on what terms, and in what sequence. And you should have a rough idea, at least of what this, if not for you, but of some other startup like you, or in this industry, how do people typically get capital and stuff like that. So this is just something that I find handy to kind of force the thinking and help you clarify, because otherwise it can get a bit overwhelming. So that brings us to the third piece, which is you need to steer your startup with simple controls. Now, I don't want to give you like a big dashboard, but I will leave you with this. There are 4 things. Keep it simple. Keep 1 or 2 metrics, but you have to look at metrics at least at a monthly level. Number 1, most important, is cash. How much cash do you have? How much is coming in? How much is going out? And can you breathe? Cash is oxygen, right? If you don't have cash, you have no business. Doesn't matter how profitable you are. Number 2, expenses. What's your burn rate, right? They talk about burn rate, but most of us bootstrap folks, how can you keep these low? How can you get creative? Number 3, revenue. At some point, you're going to have to bring in the money. Who is that person? Is it a funder? Is it your customer? Is it a buyer? Is it a user? And is the dog eating the dog food? You went in with a premise that said, look, this laundry detergent is going to be so great and people are going to pay $7 as opposed to $3 that they pay for their, private label brand Target laundry detergent, for example. You need to be able to prove it and say, am I actually seeing that come to fruition? And the only way you know that is through sales and revenue. And lastly, capital. Like, I have all these plans. Do I have enough money? How is it all coming together? Simple spreadsheet, 4 numbers, all you need, but every number tells a story and you need to listen carefully and heed its lesson to make sure that you're giving yourself the best possible shot at building an amazing startup. So I've covered a lot of ground. Where does it all kind of come together? Number 1, road test your business model, right? I can share that map, that it's on my LinkedIn, but I can share it with folks here as well. Are you able to boil it down to that simple canvas that says, this is my idea and this is why it works and this is why I'm willing to stand by it? And then think through the size, the scale, the returns that we talked about in the capital canvas, and then understand at least your basic numbers for cash and expenses for the next 3 to 5 months. Can you survive? Where's the cash coming in? Maybe the cash is coming in from your job and you're working your job, or you're offering a service and that service is funding this. But you need to understand, like, if your job is making, I just make this up, like, let's say your job is making $10,000 a month. Maybe you need $7,000 to live and you can only put aside $1,000 from your monthly income for, outside of taxes and all that stuff for, for your business. So that needs to be in your cash flow. It's like, okay, if I'm going to have to make this big investment or go to this conference or go do that or build this prototype, where's the cash coming from? Make sure you understand that. So that's 3 things. If you just keep it simple and say, I need to be able to have a handle on all of these 3 things. It's a very light infrastructure. It's a very sustainable infrastructure, and you make sure that you don't like run off the roads or your car doesn't break down in the middle of the desert in Nevada when you're trying to go to LA from New York, right? As the case may be. So that's kind of where I'll leave it. And as a benefit to the folks on this call, I'm building a business model assessment tool, a diagnostic. It's called Fit to Fly. It's a different metaphor, but it's the same principles. It's an assessment test that takes about 10 minutes. You don't need to share any numbers. You just need to answer questions. And I'll give you an assessment of the 7 areas which an investor or funder typically looks at, and tell you kind of where you score on that, as like a diagnostic that you can use to think about for your own startup. So that's it from me. Any questions? I'm happy to take.
Thanks a lot, Shubha. So yeah, the capital canvas is really interesting, because even in business school, they have business model canvas or lean canvas, but then trying to use that for fundraising is not going to work, especially if you are, let us say, a sustainable startup, right? So that's a real good understanding, and also not always rely on VC funding, right? It should be your last possible option. You should be able to try other options unless you really want VC funding. Then, of course, you have to compromise in terms of control and balance and meeting higher targets in a shorter period of time. Thanks so
excellent
much.
points.
Yeah, I put your website here. Anyone wants to contact, and then Primi, this could be a place where if you go to Shubha's website, fill in that simple
Well,
survey.
sorry, 1 second. Sorry to interrupt. If you want the questionnaire, it's fresh off the press. So email me and I will send it to you.
Yes. All right. So, Primi, this would be a place maybe you can get started. Just send an email to Shubha here. The email is on the slide. And maybe you can take a simple assessment, and then Shubha can guide you with some of the next steps that you can approach in terms of balancing your philanthropic versus revenue generation aspects.
Yeah, and thank you for clarifying that, Boaz. So if you want to take the assessment, please send me a quick note at my email, and I'll send out because it's not public, I'm only offering it, as a complimentary benefit to the folks on this summit. So email me and I'll send you the survey, the assessment tool.
Wonderful. Thanks a lot, Shubha. So I have one question from Laura. I'll read it out. So
Yeah.
these are very practical examples that you have shared, many times overlooked by startups that are fundraising, because typically the focus is on the pitch deck and trying to showcase what you can generate versus what the funder is trying to look from you. So how can they be made more digestible and attractive to founders who may not be thinking about this when looking for capital to launch, right?
So how can what be made more digestible? Help me understand so I'm answering the right questions.
So some of the aspects that you mentioned here, right?
Yeah.
Many founders are not paying attention. So if you are someone who's an advisor or a mentor or part of a team at a founding company that's trying to fundraise, what you can bring to their attention so they can go through this evaluation before they start fundraising?
Yeah, excellent question. So if it sounds like, Laura, you're in a position to kind of influence a founding team and you want to get the founding team to be thinking like this. Excellent question. Yes, you should be doing that. So amen to that. More power to you. If you want to do that, I'd suggest a couple of different ways. One is have these tools handy and ask the questions. Hey, what are we doing about X? What do we think is the right kind of capital provider? What are we offering to them? What is our return expectation? What is our horizon to exit? What is this and what is that, right? So you ask questions in a way that makes them say, wait a second, I haven't thought about that. And then you engage in dialogue. This is not something where you check the box and say, oh, I figured that out. It evolves as your own understanding of the market evolves, as your design of the startup evolves, and as you learn more about the market. So for example, in 2021, VC market was hot, right? Of course, it's always difficult for diverse and women founders in certain other sectors, but it was much hotter, and then it fell off a cliff in 2022, and now it's basically dead. Like there's nothing there, right? So those things will change, and as a result, your fundraising path and roadmap will also change. So it's a way to keep that conversation going. And my hope is that through this canvas or these tools, you cannot overload your brain. You're here not to raise funds. You're here to run a business, right? And to build something great. And you should be focused 90% on that. So this is a simple way to say, what are the 3 things I really need to be focused on? And then how do I make sure that everybody's focused on that and everything is kind of working together to build that, the green vehicle ecosystem that we talked about. You have a car that runs, you have the right fuel, and then you're guiding it the right way. Hopefully that answers the question. If not, Laura, just ping me and I'm happy to chat offline also.
I think Laura's happy with the answers. Thanks, Shubha. And
Thank you.
I had one last question. What is one thing that I can do to get started? I know there are several things that need to be done, but let us say I'm a very early stage startup. What is one thing that I can start tracking or doing to get to this journey?
I think
That'll
the
make my
one thing,
journey faster and easier potentially.
thank you. It's a great question. I think the one thing that I urge like all the founders I talk to do is to have a crystal clear idea of your market, your offering, right? And proof of why it works. Without those three things, you don't have a story. And I've seen the most struggle founders have with articulating what is the solution, like what is the product, what is the solution, what's the market, how is it coming together? If you don't have like a thing that this is my thing to offer, and if all those parts I talked about aren't working together, then you can build all the pitch decks in the world, the car won't work.
Correct. Yeah, no, definitely. Thanks, Shubha, for that. And Primi, any questions from you? Lara, Sanita, any questions, please do share. Or else we'll share all the resources that Shubha is going to send us along with the email and everything.
Awesome. Great. Thanks very much. Wish you all the best. I'm super excited about climate and sustainability. So I'm happy to chat offline or, be in touch with anybody who wants to chat for a little bit. I'm happy to be a resource if, via email or whatever works for you. Thank you, Bhuva, for putting this together. I think the work you're doing is amazing and I've seen all of the hard work that you've done. So thank you for that.
Thanks a lot, Shubha. And today being close to Earth Day, Earth Month, and Earth Week, it's really important to talk about this mission. Thanks so much for joining in.
Thank you, guys. Have a great weekend.
Thank you. Have a good weekend.